So I'm going to take you through the material in Chapter 3 and Chapter 5 of the Green Budget. The first one looks at the fiscal rules that the Chancellor has chose to set himself. The second one looks at the risks to his revenue projections and talks about why revenues might end up being different to what the OBR expects. The big picture of what the Chancellor is going to try to achieve is shown by this chart. You can see total public spending in green, measured as a share of national income, and total tax and non-tax receipts measured in blue as a share of GDP. And the graph shows it back to 2001, which is the last time that tax receipts were in excess of spending, the last time we ran a surplus. What the Chancellor wants to do is to close the gap between the two, eliminate the deficit through a combination of further rises in the tax burden and further cuts to public spending as a share of national income. And by 2019-20, he needs to be in surplus, and he's forecasting a surplus of £10 billion, about 0.5% of GDP. And I think it's important throughout this presentation to bear in mind that £10 billion number. A crucial thing to consider is the £10 billion a large margin, a large cushion, or is it quite easy to imagine situations where that buffer could disappear and the Chancellor would have to be forced into action if he still wants to deliver a surplus before the next general election? So the Chancellor actually has three fiscal targets. The first fiscal target is that public sector net debt, as a share of GDP, should fall every single year until we get to budget balance. Now, clearly the idea behind this rule is to say, well, the indebtedness of the public sector relative to the size of the economy should decline. So if you were to try and meet this through selling your assets, it would clearly be contrary to the underlying principle behind the rule. Unfortunately, on the latest forecasts, the OBR is suggesting that the rule is only going to be met this year and next because the government is selling assets. So if it does do that, that will be contrary to the underlying principle. And after the break, ICAW will give you a presentation on the whole of government accounts, which will take into account the assets as well as the liabilities that the government faces. The second fiscal target the government has is a cap on forecast welfare spending. This is a limit on how much we're allowed to project spending on the bulk of social security benefits and tax credits for each year going forwards. And the Chancellor introduced this just 2 years ago in order to try and help it make it easier for Chancellors to make unpopular welfare cuts rather than just allow social security spending to rise in an unplanned or inappropriate way. Unfortunately, the welfare cap is already being breached. Spending is forecast to exceed the cap in each of the next 3 financial years, so it's not really clear that this fiscal rule is also a constraint on the Chancellor's behaviour. So what we're left with is the new fiscal mandate. This says that the Chancellor will achieve a budget surplus in 2019-20 and every single year thereafter, unless growth drops below 1%. And that's the fiscal target that I'm going to focus on in this presentation. So the reason the Chancellor wants to reduce the deficit is to get debt down. So it raises the question, should we be trying to get public sector net debt down? And if you look at it as a share of GDP, it's certainly worth saying that UK government debt is high by recent historical standards in the UK. It's also high relative to most other advanced economies. But it's also worth noting that at 80% of GDP, actually UK government debt was above this level for long extended periods if you go back further in history. And if you look at the very largest economies, they also tend to have higher levels of public sector net debt than most other advanced economies. So the UK doesn't look quite such an outlier if you look at a longer period of history or compare it to the largest economies in the world. But there are good reasons to want to reduce public sector net debt as a share of GDP. I think the argument the government would stress would be the concern that, well, if another recession or another crisis comes along, that might mean that we want fiscal flexibility to increase debt quite considerably. And if our debt is already high when we go into that problem, there may be a concern that the debt will reach such a level that we may struggle to finance it at reasonable cost. Now, the chances of that happening may be remote, but we also know the cost of such a problem would be very, very big indeed. So the government's trying to reduce that possibility even further. And another reason why you might want to push public sector net debt down is, of course, you might be concerned about how much we're going to be spending on debt interest payments in future. The lower our debt, the less we'll have to spend on debt interest payments, all else equal. So this chart here shows you the recent history of public sector net debt since the 1970s. You can see that the financial crisis led to it doubling from about 40% of GDP to the 80% of GDP it stands today. You can see that the OBR is forecasting it to fall over the next few years. Now, over the longer term, if we think the economy is going to grow as the OBR expects over coming decades, then we don't actually need to run a budget surplus to get debt down as a share of GDP. As long as you're increasing debt less quickly than the economy, debt as a share of GDP will continue to decline. So the purple line, which you might be able to see on this chart, shows you public sector net debt would fall if we were borrowing about 1.5% of GDP a year. So that's a scenario where the government invests what it's currently planning to invest, but borrows to pay for that. Now, of course, if we ran a budget balance, or indeed if we ran a surplus of 0.5% of GDP, and it didn't affect growth, we would see debt falling much more quickly. And it's also worth noting that that 40% level that we were running pre-crisis, well, even on the surplus of 0.5% of GDP, we wouldn't get below that threshold till about 2030. So there's going to be an extended period of time where debt will be above pre-crisis levels. It's also worth seeing on the graph that it's not just the financial crisis that added to debt. You can see the recession of the early 90s saw public sector net debt grow by about 15% of GDP. So you could imagine a recession coming along of a similar style of the early 90s one, adding considerably to debt. And it's that kind of risk that the government is trying to eliminate. In terms of achieving a budget surplus, it's worth saying that if we do get to budget surplus and maintain it, that will be a break from recent UK history. The chart here shows the government deficit as a share of GDP each year since 1948, and the highlighting here shows you the years in which we had a budget surplus. Now, if we ignore the period straight after the Second World War and we start the clock in 1952, you can see we've only had 8 years of budget surplus in that period. New Labour managed 3 years in a row in their first term in office. The last Conservative government managed 2 years in a row in the height of the 1980s boom. So we've not often had surpluses, and we've never maintained them for any prolonged period. We've never managed more than 3 years in a row. So getting there and maintaining it really would be a break from the past. We've also looked at other advanced economies in the Green Budget, and we see there that actually the UK is not an outlier here. Budget surpluses really are quite rare in advanced economies, and they're particularly rare in the largest economies. So I've said that public sector net debt will fall as a share of GDP as long as you're adding to your debt stock by less than the rate of growth in the economy. And in that sense, there's not really much economic difference between running a small budget deficit or a small budget surplus. But of course, if you do get the surplus, if you run a bigger surplus, a significantly bigger surplus, or a smaller deficit, you will get debt falling much more quickly. But it's worth remembering there are lots of reasons why you might want to borrow, at least in some periods. Perhaps most obviously, investment spending could be used to justify borrowing. If you've got a big upfront investment, costs a lot of money up front, it's going to deliver benefits for some time, you might think it's sensible to borrow and do that investment. At least that may well be preferable to the world where you don't do the investment at all. Particularly if interest rates are low, you might want to take advantage of the fact that you can borrow to carry out that investment. There's also other reasons why you might want to borrow in some periods, or at least have looser fiscal policy in some years than others. And they tend to relate to situations where you've just had a negative shock. If you've had a negative shock and it's only a temporary one, you might think, well, we'll just run looser fiscal policy for a while and then things will bounce back. And even if you've had a negative shock and it's a permanent shock, you might want to adjust policy gradually. You might want to adjust taxes and spending gradually to get you back to a medium-term equilibrium. So there's several reasons why borrowing can be seen as a completely appropriate thing for governments to do. I'm not getting any. So let's look at the fiscal mandate in a bit more detail. So the fiscal mandate the Chancellor has set out says that from 2019-20 he must achieve a surplus, and he must achieve one every single year thereafter. And there's an escape clause that says that the rule is suspended if at any point over the last 4 quarters it looks like growth has been below 1%, or if the OBR is forecasting growth of below 1%. And something in the fiscal mandate's favour, I think, is it's very easy to describe, it's very transparent. It doesn't involve trying to work out what government spending was investment and what was not investment. It doesn't involve trying to do a cyclical adjustment. It's just, is the total amount of money going into the public sector bigger or smaller than the total amount of their spending? We have to run a surplus unless growth is below 1%. So what about the 1% escape clause? Well, the chart here shows you 4-quarter GDP growth since the mid-1950s. And the horizontal line here shows you where 1% is. And it looks like the 1% has been pretty carefully chosen. It means that if we had had this rule over this period, we'd basically have suspended it on 4 occasions: the mid-1970s, the early 1980s, the early 1990s, and the late 2000s. The rule, if it had been in place, would have allowed us to run deficits during the 4 major problems that the UK has had economically over this period. Now, of course, this isn't the data that would be used in real time. The government would be using the GDP estimates as they come out. We've checked using the data available at the time, and you still get pretty much the same pattern. It's those 4 periods and those 4 periods alone when the rule would have been suspended. And also, if you chose a slightly different threshold, if you chose a 0.7% or 1.3%, you wouldn't really get a different picture. Again, it would have just been those 4 occasions when the rule would have been suspended. And that's kind of interesting. It's saying that the UK economy tends to tick along growing at 2% or more, or if growth drops below 1%, you tend to have a full-blown recession. The UK economy hasn't had extended periods where growth bounces around 1%. And in fact, you can extend this graph back to the 1700s and see that in the majority of the time, that is the case. You don't often see growth just around the 1% level, unless you're going to have, or just recovering from, a recession. So the 1% looks quite carefully chosen with that in mind. But there are 3 problems with the fiscal mandate. Firstly, if you're promising to achieve a surplus in a given year, well, unless you aim to achieve it with a substantial margin, there's going to be a reasonable chance that some shock comes along, which means that you're going to break the rule, or you're going to have to do some very quick adjustment on the tax side or the spending side. So to illustrate that, we've looked at forecast errors made by the Treasury and the OBR for the coming financial year. So you take the forecast made in a March budget and you say how incorrect, how accurate was the forecast for the deficit in the coming year. And we've ignored all of the years where growth turned out to be below 1%, because they're the years in which the rule would be suspended. And what we find is that, at least over the period where we have forecasts, there's at least a 1 in 4 chance that the deficit will be 0.5% of GDP bigger than you expected. So you make a forecast at the start of the year, there's a 1 in 4 chance it will be bigger than to the tune of 0.5% of GDP or more. Why does this matter? Well, imagine if the world turns out exactly as the OBR expects, right the way through till March 2019, and we don't have any policy changes. Everything's going exactly as we would read in the latest autumn statement. Well, if the Chancellor in the budget of 2019 kept with the plan that he currently has, he would still have a 1 in 4 chance of having to announce in-year tax rises or spending cuts to deliver the budget surplus before the general election that he has promised. Secondly, the rule is forbidding borrowing unless growth happens to be below 1%. So it means that if interest rates are very, very low, if that makes certain investment projects very, very attractive, it means you can't borrow to pay for them. And it means that there might be investment projects out there which should go ahead, could go ahead and should go ahead, that you're not able to take, not able to do. And one thing we do know from economics is that the optimal level of borrowing that a government or indeed a household or a firm does in most periods is going to depend, at least in part, on the interest rate that they face. And again, after the break, ICAW are going to talk about a modification to the fiscal rule that you could make that might allow investment spending where it did allow a financial return to be delivered to the government. And finally, I said that the 1% threshold looks quite carefully chosen on the basis of UK recent history, and indeed going further back, but it's still an arbitrary threshold. Why is government borrowing okay if growth is just below 1%, but not okay if it's just above 1%? And just because it hasn't happened in the past, the future might not look like the past. We could have an extended period where UK growth bounces around the 1% level, and it could even risk politicising the OBR's growth forecasts even more. Imagine if the OBR was going to forecast a deficit, but they were kind of not sure if growth was going to be slightly above or slightly below 1%. Well, it would really matter for the Chancellor whether they said growth was going to be a bit below 1%, because then all of a sudden the deficit's okay and they don't need to take action, or if they said growth was, whereas if they said growth was above 1%, the Chancellor would be under pressure to increase taxes or cut spending in order to ensure that the forecast deficit did not materialise. So that brings us on to the risks around the forecast. Why might the world not turn out exactly as the OBR expects? And there's 2 types of risks in the public finances. One is, if we just leave all policy settings as they're currently expected to be, perhaps public spending or tax receipts will not turn out as what the OBR expects. And the second risk is that, well, actually, policy settings will change. We know that there's going to be budgets and autumn statements where new policies will be announced, and they may make tax revenues or spending be different to what we currently expect. And perhaps the obvious uncertainty is about the level of the economy in the future. If the economy turns out to be bigger or smaller in the future, that will naturally deliver more or less in terms of tax revenues. And you've just heard from Oxford Economics, who set out a pessimistic scenario. In their pessimistic scenario for the economy, GDP at the end of this Parliament would be about 0.7% lower than what the OBR expects, and that would be about enough to eradicate the whole of the £10 billion surplus that the Chancellor is expecting. But it's not just the level of the GDP that matters for tax revenues. The distribution of that GDP, the composition of that GDP, and other things such as oil prices and asset prices matter too. And I'm going to talk in detail around some of those. So starting with employment and earnings, these matter hugely for the public finances because we collect so much tax on employment income. PAY income tax and national insurance are in total forecast to total £262 billion in the current year. And the forecasts the OBR have made in the past for both earnings and employment have turned out very different to what we expected. So in the left-hand panel on this graph, I'm going to show you the rate of growth of earnings in the economy that the OBR was forecasting, and in the right-hand panel, I'm going to show you the rate of growth of employment. And the first line you see here is from the November 2010 forecast. Now, to give you a sense of scale, if earnings turn out 1% different to what the OBR expects, that hits the public finances for about £5 billion. If employment turns out 1% different to what the OBR expects, that hits the public finances to the tune of about £3 billion. And as we roll through time, looking at successive forecasts, you see a pretty consistent story. You should see a pretty consistent story. The OBR has been revising down its forecast for earnings growth and revising up its forecast for employment growth. On its own, the earnings revisions would hit the public finances for about £40 billion a year. On their own, that's negative. On their own, the employment changes boost the public finances by about £35 billion a year. So very, very big revisions have happened, and they matter a lot for the public finances. What might we expect in the budget? Well, if you read last week's Bank of England inflation report, you can see that the outlook they have for employment growth over the next few years hasn't changed since November, but the outlook for earnings growth has been revised down by more than 1%. So if the OBR was to follow suit, you might expect a downward revision to these receipts of £5 billion or more. Second tax I want to talk about is a much, much smaller tax, but one that's very, very volatile. It's stamp duty collected on residential property transactions, forecast to be about £8 billion of revenue in the current financial year. And on the left-hand scale, we have residential property prices. They clearly matter for stamp duty receipts. And on the right-hand graph, we have transactions, which also matter. We start with November 2010, and we go through each autumn's forecast. Now, here you can see that the OBR has revised up its expectation of house prices, but on the right-hand panel you can see it's revised down its forecast for transactions. And in particular, between July 2015 and November 2015, it revised down forecast transactions down very, very significantly, and this was enough to wipe out about a quarter of the amount of tax it expects to collect, about a £2.5 billion downgrade to stamp duty revenues in the current year. So a tax that doesn't collect that much in terms of money, but one that's very, very volatile. Things that have changed since November include the drop in oil prices that Andy mentioned, and also a drop in equity prices. Now, these have quite different effects on the public finances. We know that when oil prices go down, the government gets less money on North Sea oil and gas production. But as the OBR points out, when oil prices go down, you also collect more in tax revenue from field duties because people use more petrol. You also get a boost to onshore activity in the UK economy, and that boosts taxes elsewhere. So the green line here shows you the oil price over time, measured in pounds per barrel, which is what matters for the UK public finances. To show you how much the oil price matters for North Sea oil and gas receipts, we can look at the March 2014 forecast, which was for the oil price to remain around £60 per barrel, and the one they produced back in November, which was the oil price to drop to below £40 per barrel. That revision was associated with a downgrade in forecast receipts of about £3.7 billion, virtually eliminating the amount of tax we expect to get from North Sea oil and gas production in the current year. So we might well expect a further downgrade in the coming budget, but I think it's very important to remember there'll be a boost elsewhere in the public finances. There won't be a net hit from the decline in the oil price seen since November. That's not the case with the change in equity prices. These directly affect receipts of inheritance tax, capital gains tax, and stamp duty on shares. Altogether, they total about £14 billion a year. And in addition, when equity prices fall, you get a further hit to income tax and corporation tax receipts related to the activities of the financial sector. The graph here shows you the FTSE All-Share Index over time, up to July 2015. What the OBR does is it takes the current level of the FTSE All-Share and then assumes it will grow in line with its forecast for GDP. So that's what they were assuming last summer. By November, the FTSE All-Share had dropped, so the OBR revised down its projected level of the FTSE All-Share Index by 7.4%, and it revised down its forecast capital tax receipts by £2 billion. Since then, by coincidence, the stock market has dropped by another 7.4%, so we may well expect that to lead to a £2 billion downgrade in receipts in the coming budget. So that's the risks to underlying revenues. The final set of risks I want to talk about are the risks in terms of policy changes. Where might the Chancellor change policy and how might that affect the amount of tax he's going to collect? Well, the most obvious place to start is the Conservative Party manifesto. It commits to a personal allowance in the income tax system of £12,500 and a higher rate threshold of £50,000. But under current government policy, standard uprating wouldn't get you there. And we estimate that if they want to deliver on this promise, it will hit revenues for about £8 billion. So there's an £8 billion unfunded tax cut still kicking around in the Conservative Party manifesto. So that's one form of indexation risk. Another one is that the public finances assume that certain thresholds are going to be uprated in particular ways, or in some cases not uprated. And we might question how sustainable this is, or whether it's really going to happen. So most obviously, fuel duty rates in the public finances, these are projected to go up in line with the RPI every April. But if you look at the Chancellor's actual behaviour in recent years, you see that every April since 2011, he's actually frozen these in cash terms, or at least hasn't increased them at all. If he continued that behaviour, if he continued not to increase fuel duty rates in cash terms at all, that would hit the public finances by £3 billion by the end of this Parliament. And finally, there's some thresholds which are frozen in cash terms. The point at which you start to pay the 45 pence rate of additional tax kicks in at £150,000. That's not uprated at all. It stayed at that level since it was introduced in April 2010. Partly as a result of that, that means the number of people facing that tax rate has grown. There's now 40% more additional tax rate payers than there was back in 2010-11. Secondly, the 50,000 threshold, the point at which you start to lose some or all of your child benefit, is also frozen in cash terms. And we forecast that if that remains in place, there'll be a 50% increase in the number of families who will be losing some or all of their child benefit in 5 years' time compared to now. And the final policy I want to talk about is one that we may well be hearing more about in the budget. The government's going to respond to a consultation on pension tax relief. And this is potentially a very, very big policy. So at the moment, we give income tax relief on most pension contributions, and we charge income tax on most pension income. That's how the income tax system treats pension saving and pension income. And the government's been consulting on whether to reform this. Now, one option is to keep the status quo. Nothing changes. But there are two radical reforms which we believe are under consideration. One is to make the amount of relief that basic rate taxpayers get more generous and make the amount of relief that higher and additional rate taxpayers less generous, but don't change how we treat the taxation of pension income. The other potential reform is to flip the system round and say actually pension contributions will be made out of taxed income, so we will tax the contributions when they go into pensions, but we'll promise not to tax the resulting pension income when it's drawn in the future. So you'll pay the tax up front rather than when you receive the actual income. Now, in terms of the public finances, if the government did go down the route of these radical reforms, they would have very big, very complicated effects on tax revenues, and potentially some temporary effects as well as some permanent ones. And clearly there's a risk here that there's a big upfront tax rise, only part of which proves to be permanent and part of which proves to be temporary. And I think if the Chancellor was to achieve a budget balance in 2019-20 on the back of temporary revenues, that would be contrary to the principle underpinning his fiscal target. So that's me done on the tax side.